His wasn't a rate hike, this wasn't a press conference, and this definitely wasn't business as usual. Within minutes, markets snapped, stocks sold, gold and silver dropped, and the illusion holding the system together cracked. This was a signal event. Because when leadership changes at the Federal Reserve this abruptly, it's not about policy tweaks, it's about ending an era. And most investors are completely misreading what comes next. This was not a normal market reaction. This was systemic shock. When the news hit, it didn't just move prices, it reset behavior. Stocks didn't slide because of earnings. Metals didn't drop because demand vanished. Everything sold because certainty evaporated. And in modern markets, certainty is the most valuable asset of all. The moment investors realized the rules might be changing, they didn't wait for clarity, they rushed for exits. That's not panic, that's professional instinct. Before we go any further, if this breakdown is hitting home, take a second to subscribe and switch on notifications so you stay ahead of what's coming next. Also, drop a comment below and let me know where in the world you're watching from and what time it is right now. This channel spans the globe, and I always like seeing how far this conversation reaches. Leave your location and local time, and I'll see you in the next one. For years, markets have been conditioned to believe one thing above all else. Someone will step in. If risk gets ugly, liquidity appears. If volatility spikes, policy softens. If leverage breaks, emergency measures arrive. This belief wasn't ideological, it was operational. Entire portfolios were built on it. Strategies assumed it. Algorithms priced it in. Risk models depended on it. When leadership at the top of the system changes suddenly, the first thing that dies isn't price. It's that assumption. That's why the reaction was so violent and so fast. This wasn't fear of tightening. This was fear of abandonment. Markets don't mind pain if it's managed. What they can't tolerate is the possibility that no one is coming. When investors sense that the safety net might be pulled away, even temporarily, they don't debate fundamentals, they liquidate exposure. Correlations rush toward one. Everything becomes a source of cash. That's why gold and silver sold off alongside stocks. Protection was sold not because it failed, but because it was needed to cover losses elsewhere. This is what forced deleveraging looks like in real time. Margin calls don't care about narratives. They don't care about inflation, deficits, or geopolitics. They care about one thing, collateral. When volatility spikes, leverage becomes radioactive. Funds that were positioned for stability suddenly face survival math. Positions that took years to build get unwound in hours. And the most liquid assets, even the ones meant to hedge chaos, are the first to be sacrificed. That's not bearish for metals. That's how every major reset begins. What made this shock different was its psychological impact. This wasn't a scheduled meeting or a gradual shift. It was abrupt, decisive, unpredictable. Markets can digest bad news. They can even digest aggressive policy. What they struggle with is a sudden loss of narrative control. For over a decade, the narrative was simple. Stability is manufactured, volatility is temporary, risk is managed from the top. This announcement challenged that story in a single stroke. The sell-off wasn't about today, it was about tomorrow being unclear. Investors weren't repricing earnings. They were repricing the entire framework under which assets had been valued. When the referee changes mid-game, players don't argue the call. They step back and reassess whether the game is still worth playing. That pause, that moment of hesitation, is deadly for overextended markets. Liquidity thins, spreads widen, and price moves accelerate in both directions. This is why calling this reaction irrational misses the point. It was brutally rational. It was the market saying, "We don't know the rules anymore." And when that happens, the first move is always the same. Reduce exposure, raise cash, survive first. Only later does capital reallocate to assets that benefit from the new regime. This shock wasn't the end of the story. It was the opening scene. The moment the system revealed vulnerability. And once that vulnerability is exposed, it never fully disappears. Markets may stabilize, prices may rebound, but the memory remains. The knowledge that the backstop is no longer guaranteed changes behavior permanently. And that shift, not the headline, is what ultimately rewrites valuations, reallocates capital, and sets the stage for what comes next. Wall Street didn't recoil because of ideology. It recoiled because of recognition. The moment that name surfaced, desks across the financial system reached the same conclusion at the same time. The era of comfort was ending. This wasn't a nominee chosen to reassure markets, smooth volatility, or signal continuity. This was a name associated with discipline, restraint, and consequences. And in a system addicted to accommodation, discipline is the ultimate threat. Markets are not afraid of tightening. They are afraid of unprotected tightening. For more than a decade, financial players learned that every restriction would eventually be softened, every shock cushioned, every mistake absorbed by policy response. Risk wasn't eliminated, it was socialized. Losses were delayed, diluted, or displaced. That implicit insurance policy became the foundation of modern asset pricing. When a figure associated with withdrawing that insurance appears, the reaction is immediate and visceral. This fear isn't theoretical, it's institutional memory. Veterans remember what happens when monetary authority prioritizes credibility over asset prices. Liquidity doesn't vanish overnight, it drains. Funding costs rise quietly before exploding. Weak balance sheets get exposed. Business models built on cheap rollover financing suddenly stop working. And when that process begins, it doesn't ask for permission. Markets understand this. That's why the response wasn't curiosity, it was retreat. What terrifies Wall Street is not hawkish rhetoric, it's predictable resolve. A central bank that signals hesitation can be gamed, a central bank that signals flexibility can be pressured, but one that signals commitment to long-term stability over short-term pain cannot be negotiated with. That removes the most powerful tool markets have relied on, influencing outcomes through reaction. When participants sense that jawboning won't work, leverage loses its edge. This is why the name itself mattered more than any policy outline. Markets trade credibility before they trade numbers. And credibility, once established, doesn't need constant reinforcement. It operates silently, like gravity. Risk premiums rise not because of announcements, but because assumptions change. The assumption that excess will be tolerated, the assumption that drawdowns will be capped, the assumption that the system exists to protect asset holders above all else, that assumption just cracked. The deeper fear is that this signals a return to first principles. Price stability over asset appreciation, currency strength over speculative growth, systemic resilience over short-term market happiness. These priorities are rational from a policy standpoint, but they are hostile to a financial system structured around perpetual intervention. Entire strategies depend on the belief that volatility will be smoothed and liquidity restored. Remove that belief, and the architecture collapses inward. This is why uncertainty spiked instead of clarity emerging. Markets didn't know how far resolve would go, and that's precisely the problem. When discipline replaces accommodation, there is no predefined floor, no automatic rescue threshold. Pain becomes part of the adjustment process rather than a signal for intervention. That changes behavior at every level, from hedge funds to corporate treasurers to sovereign debt markets. What Wall Street fears most is not a crash, it's adaptation. Crashes are fast. They can be traded, they can be hedged. Adaptation is slow, grinding, and unforgiving. It forces leverage out of the system permanently. It reprices risk across cycles. It rewards patience instead of speed. And it shifts power away from financial engineering toward balance sheet strength and real assets. That's why the reaction was so sharp. Not because anyone knew exactly what would happen, but because they understood what could happen. And in markets, possibility is often more powerful than reality. This wasn't a response to policy. It was a response to a message. The safety net may no longer be unconditional. Once that message is received, it cannot be unheard. The system can adjust. Prices can stabilize. But the mindset changes forever. And when the mindset changes, capital moves differently. That's what Wall Street recognized in that name. And that's why it flinched. This is the moment the illusion finally collapsed. Not slowly, not politely, decisively. The era of easy money didn't fade out. It was cut off. For years, markets were trained to believe that liquidity was infinite, that cost of capital was optional, and that risk could always be postponed. Money was no longer a constraint. It was a convenience. That belief didn't just inflate assets, it rewired behavior. And now that wiring is being ripped out. Easy money was never just about low rates. That's the surface level misunderstanding. It was about permission. Permission to borrow endlessly. Permission to speculate recklessly. Permission to mistake leverage for intelligence. When capital is free, discipline disappears. Balance sheets become cosmetic. Valuations detach from reality. And the system drifts further from resilience with every cycle. What just ended wasn't accommodation. It was tolerance. The defining feature of the easy money era was not stimulus, but predictability. Markets knew the response before the problem fully appeared. A wobble in growth, liquidity, a market correction, reassurance, a systemic threat, intervention at scale. This wasn't subtle. It became embedded in algorithms, corporate planning, sovereign budgets, and investor psychology. Risk didn't vanish. It was anesthetized. Pain signals were suppressed. And when pain is suppressed long enough, damage accumulates invisibly. Now that suppression is gone. The shift underway is brutal because it restores consequences. Capital once again has a price. Debt once again demands respect. And volatility once again serves its original function, exposing weakness. Markets hate this because volatility is honest. It reveals who is overleveraged, who depended on refinancing miracles, who confused favorable policy with sustainable business models. Easy money hid those flaws. A disciplined regime puts them under a spotlight. This is why asset prices reacted so violently. Not because tightening is new, but because unconditional support is gone. When money is no longer cheap and predictable, everything gets repriced at once. Growth assumptions shrink, multiples compress, long-duration assets lose their magic, and suddenly, The future matters again. Cash flow matters. Survival matters. The fantasy of endless expansion, funded by borrowed time, evaporates. A strong currency posture accelerates this reckoning. You cannot defend purchasing power and inflate assets simultaneously. One requires restraint, the other requires excess. For over a decade, excess was chosen. Now restraint is back on the table. That's not a policy tweak. That's a philosophical reversal. It signals that stability will no longer be manufactured through liquidity injections, but earned through adjustment. And adjustment is painful. The most dangerous part of this transition isn't the initial sell-off, it's the aftershock. Companies that survived only because refinancing was cheap will face reality. Governments accustomed to low-cost borrowing will feel pressure. Financial instruments engineered for a world of suppressed volatility will fail under stress. This isn't a single event, it's a process. And processes don't reverse easily. Easy money also destroyed time preference. Investors stopped thinking in cycles and started thinking in quarters. Speculation replaced patience. Speed replaced diligence. In a disciplined regime, that flips. Capital flows toward durability, toward scarcity, toward assets that don't depend on policy kindness to exist. That transition doesn't happen quietly, it happens through revaluation. This is why the end of easy money feels like betrayal to markets. Not because it's wrong, but because it's unfamiliar. A generation of participants has never operated without a guaranteed backstop. They don't know how to price risk without guidance. They don't know how to function when failure is allowed. But systems that don't allow failure eventually fail catastrophically. What we're witnessing is not the collapse of growth. It's the restoration of reality. Easy money delayed consequences. It didn't eliminate them. And now those consequences are re-entering the system with compound interest. The rules are changing. The training wheels are coming off. And in that world, only assets rooted in scarcity, discipline, and permanence retain their power. Markets can survive crashes. What they cannot survive is ambiguity. A crash is violent, but brief. It delivers pain quickly, prices it in, and forces a reset. Uncertainty, on the other hand, lingers. It corrodes confidence slowly, invisibly, and relentlessly. That is why professionals fear it more than red screens. When the future becomes unclear, capital doesn't rush in. It withdraws, waits, and demands a higher price for risk. Bad news is manageable. It can be modeled, hedged, and traded. Uncertainty cannot. When outcomes are undefined, probability distributions explode. Risk models fail. Correlations rise. Liquidity thins. And decision-making freezes. This is the environment markets just entered. Not a known tightening cycle, not a predictable slowdown, but a period where the rules themselves are in flux. That is toxic for overextended systems. In uncertain regimes, behavior changes instantly. Investors stop asking, what will happen? And start asking, what could happen? That shift is deadly, because could has no ceiling. When policy signals are unclear, every scenario must be priced in, even the uncomfortable ones. That forces capital to retreat from complexity. Leverage becomes unacceptable. Long-duration bets lose appeal. Optionality replaces conviction. Cash becomes king, not because it yields more, but because it buys time. This is why volatility spikes even without catastrophic news. Volatility is not fear. It is confusion made visible. It reflects disagreement about the future. When clarity disappears, prices swing violently as participants test levels, pull orders, and re-anchor expectations. Market makers widen spreads. Liquidity providers step back, and price discovery becomes erratic. This is not chaos. It is the market trying to find a new narrative. Professionals understand this instinctively. They don't rush to buy the dip when the framework is unclear. They wait, they preserve capital, they let weaker hands get shaken out. Crashes reward speed, uncertainty rewards patience. And patience is only possible when you're not overexposed. This is also why uncertainty punishes paper promises first. Assets dependent on confidence, leverage, and continuous rollover suffer the most. When the future is questioned, anything that requires trust to function becomes fragile. Real assets don't explode higher immediately. But they don't break either. They sit quietly while financial claims get repriced around them. Uncertainty is not an event. It's a regime. And regimes change behavior long before they change headlines. Once markets internalize that clarity won't return quickly, they stop chasing upside and start prioritizing survival. That's the shift underway now. And history is clear. When survival becomes the objective, capital eventually migrates towards scarcity, durability, and things that don't depend on belief to hold value. Silver is no longer trading as a commodity. It is being reclassified by power. Quietly, strategically, relentlessly. What markets are missing is that this is not about price discovery anymore. It's about control of flow. When governments begin coordinating around metals, they are signaling something far more serious than support for industry. They are signaling scarcity at scale. and fear of losing access. Strategic weapons are not defined by what explodes. They are defined by what cannot be replaced. Silver sits at the intersection of energy, defense, electrification, and technology. It is embedded in systems that modern economies cannot function without. Yet it is mined as a byproduct, refined through fragile supply chains, and stockpiled in amounts that look laughable against future demand. That imbalance is the vulnerability, and vulnerabilities are always weaponized. Price floors are not economic tools. They are admissions that supply is tightening, that market pricing no longer reflects reality, that allowing prices to fall risks breaking production, choking future availability, and surrendering leverage to adversaries. When states step in to stop prices from dropping, they are no longer managing markets. They are managing survival pathways. That's the shift happening beneath the headlines. Silver's role has changed because the world has changed. Energy systems are no longer optional upgrades. They are national priorities. Defense technologies are no longer niche. They are accelerating. And supply chains are no longer global abstractions. They are battlegrounds. In that environment, silver is not cheap or expensive. It is strategic. And strategic assets are never left to uncontrolled markets for long. This is why the current paper price is misleading. Paper markets reflect liquidity, not necessity. They reflect leverage, not urgency. Physical reality moves slower until it doesn't. When stockpiles tighten and industrial demand collides with sovereign hoarding, price doesn't rise gradually. It gaps, and by the time the move becomes obvious, access is already constrained. Governments understand this dynamic intimately. That's why enforcement matters more than announcements. Export controls, strategic reserves, subsidized refining, quiet bilateral agreements. These are the mechanisms that turn metals into geopolitical tools. Once those mechanisms are in place, price becomes secondary to availability, and availability becomes power. Silver doesn't need hype cycles or speculative narratives. Its strength lies in its irreplaceability. You can't print it, you can't synthetically scale it, and you can't quickly substitute it without performance loss. In a world moving toward fragmentation and competition, those traits are priceless. This is the uncomfortable truth. Silver didn't become a weapon because markets wanted it to. It became a weapon because systems depend on it, and systems are being fortified. When that realization fully sinks in, the conversation won't be about charts or ratios. It will be about access, priority, and who secured supply before the door quietly closed. Silver's greatest advantage is also its most misunderstood trait. It exists outside the system. It cannot be created by decree, expanded by balance sheets, or stabilized by policy statements. It lives in the physical world, constrained by geology, energy, time, and labor. That single fact makes today's pricing not just questionable, but historically absurd. When something essential cannot be produced on demand, prolonged cheapness is not a feature. It's a warning. Every period in history where silver traded far below its strategic value shared the same conditions: confidence in paper systems, abundant leverage, and faith in intervention. Those conditions are now eroding simultaneously. When trust weakens, suppression loses power. Paper contracts only function while holders believe delivery is optional. The moment physical demand tightens and credibility wavers, the disconnect between price and reality snaps violently. Silver doesn't drift higher. It reprices. This is why the phrase, "never this cheap again," is not marketing. It's math. Supply is inflexible. New mines take a decade. Above-ground stockpiles are thin and opaque. Industrial demand is structural, not cyclical. And monetary demand doesn't arrive gradually. It arrives in waves triggered by loss of confidence. Once those waves hit, price discovery happens in chaos, not charts. The current pullback is not rejection. It is extraction. Weak hands forced out. Leverage flushed. Paper claims unwound. This is the final stage before scarcity asserts itself. Historically, the best opportunities in silver appear when it feels broken, ignored, and disappointing. That's the emotional cost of entry. By the time silver feels obvious, it is already unobtainable at rational prices. What makes this moment different is coordination. Governments are no longer passive observers of metals markets. They are preparing frameworks to secure supply, stabilize production, and prioritize access. Once price floors, stockpiling, and export controls intersect, the concept of a free market price disappears. At that point, silver doesn't trade. It is allocated. And allocation is exclusionary. It favors insiders, early movers, and those who acted before urgency became visible. Everyone else pays premiums or waits. That is how every strategic commodity transition unfolds. The public never gets the first signal. They get the consequences. Silver's power is not in explosive upside. It's in inevitability. You can delay recognition, but you cannot escape arithmetic. Finite supply plus rising necessity equals revaluation. The only variable is timing, and timing always compresses when confidence breaks. This is why today's price is dangerous to ignore. Not because it's low, but because it's temporary. Silver doesn't need catalysts anymore. It needs pressure. and pressure is building quietly, relentlessly, behind the scenes. When it releases, there is no rewind button. There is only repricing, and regret for those who assumed the window would stay open just a little longer.